And yeah, we're going to see what happens here. Very light book, 25625. ES has liquidity up to 60 and then down to 35. Otherwise, very, very light. Most of the stuff is 68.55 here. That's probably the biggest cumulative order that we're going to go for. I would anticipate that they're going to come up and fill the imbalance at 56. I mean, that's really all that's left here to do. Why are all presenters going by their first names except option layer? We can see who has the ego. We can see who is an idiot. How about you get off the stream and leave me alone? Continue to lose money like a jabroni that you are. 68.48, a little bit of a top wick. ES is 68 with a 15-minute red right here. Overall, we do have this little upward channel here. There's a little upward channel. I think everyone can see we have a trend line to the bottom, trend line to the top. Overall, though, the biggest volume so far of the day came at 10:33 on this move, which is why we're still here. So if you notice, we have this move right here that put on a top wick with volume, and we haven't been able to get above that. So once we do claim that, if they do, obviously we'll look for the imbalance at 57, but right now that is showing the top so far on this price action. $68.50. Not much, not moving much. Get him. Get him. $68.49 right now. So the whole theme of what I'm looking for with the 3 C's and with volume and with liquidity is two things. One, they're going to start to skew the market. Now I'm sure you can notice that I'm a little bit different from other of the bookmap streamers that I zoom all the way out. I don't like to zoom in for the individual ticks. I like to zoom out to get the whole skewed of the environment. That's the best usage for me, is that it's very easy to manipulate the order book on the short term, very fine-tuned stuff, but it's very difficult to manipulate the order book on the wider scale macro term. And that's what I'm looking at here. Where are they going to stack the liquidity lower if they do so, or higher? Right now, it's a little bit stacked lower to 68.35, and they're unable to grab the higher high on the high liquidity spike. Obviously, we had the highest amount of volume at 9:33, 10:33 Eastern, and that is why we cannot break this. So if you're wondering why, that is why. If you're trying to long this position, you're going to have a little bit of a struggle until we can finally start to capture the higher high prices. You're going to face a little bit of a drawdown. You're going to face a little bit of aggravation here. So just be patient. A higher high is going to be 68.53, and that'll get you probably another 15, 20 points if we are able to grab it. If not, then you're at risk of giving back the entire range here. So that's what we're looking for. Can you explain how zero DT flow is affecting the futures market day to day? Yeah, there is a profound effect of the zero DT options, and it's not getting any better. It's getting worse and worse every day. Back in 2000 and I think it was early 23 or late 22, sometime in that ballpark, is that the option chain began to account for most of the option trading. It was like 50%, 51% for the first time. Now it's well over 75% of the entire option chain activity is zero DT options, and that's obviously, it's throwing a wrench in the plans of how the market moves. You know, it used to be the reason why the options are called derivatives, because they're derivative of the underlying, which is the S&P or whatever else you're trading. But now most of the market, most of the option chain is 0 DTEs, and we all know that how much money those can make in a very quick amount of time. They're a very gamma-induced product. So with these moves, it's not allowing the market to sell. And there's some other options analytic tools out there that have kind of prophesized that it's going to cause the market never be able to sell until it finally has a massive sell. So the market's going to be in a perpetual buy the dip environment as long as we have 0 DTE calls on the books, until finally we have one day we're going to wake up and we're down 7% for no good reason other than a volatility event where hedging can't catch up to the 0 DTE market. And now it's causing this every single day, just buy the dip, buy the dip, buy the dip, buy the dip. Never selling. We're getting massive rally after massive rally. And a lot of it has to do with the fact is that dealers can now play a la carte. There is no need anymore, unless a major volatility event happens, such as FOMC or other names, there's no more need to put on a massive hedge position that'll spike the VIX that is 28 days out. Now you can hedge dynamically with a current environment with a put if needed. And then, of course, you close the put, you kill IV, you crush the VIX, and then pop up we go, which is what happened last week after the major VIX spike to 29 before Thanksgiving break. And now what's happening here is that we're getting continued VIX crushes here as they recycle the VIX to prepare for the next 2 weeks, which does require put activity instead of 0 DTEs, because we have CPI, non-farm payroll backlog, and then we have the week after that we have FOMC. So we have now 2 weeks of hedging needed data. And then, of course, that'll spike the VIX. But the 0 DTEs are causing this never-ending market and very volatile market when it does finally break. But yeah, it's definitely changing the game, especially someone like myself who is a VPA trader who relies on volume. I am going to have to account for options data into my strategy because it's a big player. So going back to the chart here, and I want to switch my screen over just temporarily to the volume analysis tab, is that you see the volume spike occurred here. That's the largest volume spike of the day, which tells us we have supply in this area. So whenever you see a volume spike at a high, that's supply. When you have a volume spike at the low, that is demand. And right now we have a tremendous amount of supply sitting on this area on the 1 minute chart identified. And if you go to the 5 longer time frame, you start to see the picture being painted here. Multiple top wicks in here to create this liquidity up inside where we kind of settled throughout the evening. If you go to the 15, we have still an even better presentation of these top wicks occurring at 68.52, all still holding the channel that we have plotted here. But we still have volume that is correlated across all time frame. 15 minute, 5 minute, 1 minute all have correlated high volume with a top wick back down into now 68.43. So if you're someone who's looking to play high into the imbalance, you need to be able to take out this liquidity block at now 68.51. And this is the way that I interpret just a common sense view of the market, is let the market tell you where the liquidity is. We all can see with that volume on the 1, 5, and 15 minute chart that we have liquidity in the form of supply at 68.51. That is the buy side liquidity. And once they fill that, then and only then can we even opine that we're going to go up to 68.61. But as long as they stay under that, we're at risk of giving back some or all of the little morning bounce here. But follow the wicks, baby. Follow the wicks. 2023 was crazy. Does that answer your question, Dave? Do I use Spot Gamma? I do use Spot Gamma. I am an affiliate of Spot Gamma as well. I believe the 1-2 punch of Bookmap's order flow with Spot Gamma's analytical options tool is a fantastic combination. That way you could track the liquidity on the book and you could track the liquidity in the options chain to really determine what the price is going to do. Yesterday was a perfect representation of blending those two tools, because if you remember yesterday, we had a very bullish morning. We had a bullish pre-market that led to a bullish morning for a 68.42 to 68.57, about a 15-point pop there. But the option chain and liquidity was painting a different picture. The Bookmap liquidity was posting lower skew. The option chain was showing call selling, put buying, which is both a bearish flow. And then, of course, what happened? We had two major sells. We had the one at 10.25 and we had the one at 11.05 that showed pretty decent returns on that move down. And not only were they a great range to play, but it was sustained. We didn't get a wicky, slow, grindy trend. We got a precipitous dump that would have profited a great entry. So it's a great 1-2 punch to kind of tie into those to show, all right, well, the liquidity book is pulling lower, the option chain is pulling lower. It's very difficult for the price action to fight against the stream of both of those. So I'm going to look for a short opportunity, and once my 3Cs indicated a short signal, I took the entry, and I just let the position go until it stopped out. I use alpha, spot gamma. Where am I broadcasting from? The United States. Estados Unidos, baby. Am I familiar with Voland? I am not. Below 68.40, I think we head much lower. It's possible, 100%. Obviously, we can anticipate some buying after that much quick red in the pre-market because that's the natural reaction. The market opens. Most liquidity is going to try to trace that short position to capture the momentum, and then they bounce it. They put a little pressure. And, of course, the options start to buy a couple of calls like they have been all morning here, creeping in, and we get this slow little move up. The flip side of things is that, in my opinion, this whole environment right now is the recycling of volatility. The big player's favorite trade is a volatility crush position. Shorting VIX down to spot price is one of the best trades in the business because it's very reliable and very repeatable, obviously, until it's not, until VIX goes to 30, which doesn't happen very often, but it happens, I don't know, once a year nowadays, twice a year. So what's happening here is we just had a spike to 29 on the VIX, which is a very aggressive spike on the VIX. We had a lot of volatility, and then they crushed it going into Thanksgiving for now, what are we going on, 7 days now? 6-7 days going into this market of all crush. But what do we have the next 2 weeks? We have a phenomenal amount of data, and that data is now even more robust, giving today's events. Today's events, we had ADP jobs data, which is not non-farm payroll, but is from Jay Powell's words himself, is the precursor to non-farm payroll, which is next week. So we have this volatility that's going to tick up now. It's even more expectation after today's move. So now we're going to have a VIX start to spike after whenever they decide it's time to start spiking the VIX. It could be today, it could be tomorrow, it could be Friday. But next week we have CPI, non-farm, and then the week after that we have FOMC. So all the eyes are now on the VIX. This is why we're getting this back and forth price action, and we're not really going anywhere. And then they're going to spike the VIX back up. We had another VIX spike test today that rolled back over. That's them testing that upper bounds of the VIX. Then next week after, we'll get a spike above our 20 again, and then we'll see if that's the time that it's going to go to 30 or not. But that's what's happening here. All right, so here's another attempt. We're going to attempt the 68.53. If we could take out this liquidity block, then you can comfortably look for 68.64, 68.62 right here. Can you do a review on the NASDAQ? Sure thing. Let's take a look. NASDAQ is doing the same thing. They're walking step in step here. This was my liquidity from yesterday. Let's take this off. But you see is that with that volume spike, you've got this little liquidity block. And all I'm doing is plotting the wicks here to show you that, because all the wicks tell you in price action is where the opposing party is defending that block of liquidity. That's all it's doing. You have to remember, all of this stuff right here is just a visual representation of a number book, an order book. The old ticker tape that Jesse Livermore used to use back in the day is that we're looking at it in a visual representation. So you have to understand, if you're going to trade off the visual nature, which is pretty much what we all do today, what's going on behind the scene. When I see a wick on the candles, that tells me that there's a supply order book sitting there, and it's not going to go above that until you have the commensurate volume or price action or the options flow the order flow to breach that liquidity. So now here's a third attempt to come up in this area. So this is a very important moment for the buyers. If they have another triple top without putting in a higher high, then that'll put on a pretty decent probability of attacking lows of the day. But if they breach and close with a candle 68 or 25.602, then there's a pretty dang good chance that we're going to come up and tap the pre-market high. So this is a very important time. If you're long, you would need to have your trailing stop set, I would probably say roughly in the ballpark of 560. That'll give you a temp, because if this rejects, you have to play the risk reward. If you're playing a long position here and they reject this again, the probabilities now, key word there, is likely that we're going to retrace back down to low of the day. If you're long and it's holding and it doesn't reject back down, then there's a decent probability that you can either gun for the pre-market high of 25,678. Right now, the liquidity on ES shows 68.55 on the book, and then most of which is down to 68.35. NASDAQ has 25,612 and a little bit of block of 600 here. Now, also, you need to zoom out a little bit, take a step back, and figure out what have they been doing the past 2 weeks. The past 2 weeks have been pretty much the same as this, just slow, grindy, or a little bit more trendy green morning, and then a quick precipitous dump into the afternoon. It's happening almost every day. So that's most likely what's going to set up for another attempt here. They're just going to grind it up, grind it up, grind it up. In the last 60 to 90 minutes of the day, we'll have a little sweep lower to engage the next session. Another rejection off this liquidity block. But the first and foremost thing, let me make sure y'all can see this, is this right here. Right now, that's the primary mechanism on which I'm making decisions, is this guy right here, that volume spike. That tells me is that there's a tremendous amount of supply right there. And I definitely don't want to chase a long position here if I'm not already long until we break that level. The market's telling me what to do. ES is doing the same thing here. They rejected off of it again. Obviously, we have this trend line here too. I'm not a trend line trader, but I do like to plot them just to show the patternized price action, but I don't trade off of them. I don't execute based on decisions of the trend line because I've never been able to gain an edge off of them. But you can see we do have this trend where the market is bouncing off of, and we'll look to see if we could sweep lower. For me, a 3C lower short opportunity here would have to close under 68.44. 68.44 would give me this right here. And then down we go. Liquidity just got put on the book at 25,637. How do I discern defending price action from aggressors? Well, that's a great question. So if I'm looking for a party to come in and take control of the book, for example, now, we've had a nice prolonged bullish move. If I'm looking for sellers to come in and become the aggressors and dump this, it's all through the process of my first two C's, the first two criteria, which is volume and wick. How aggressive can they put on the volume, and how aggressive can they hold the price action through the form of a wick? Right now, in the 5-minute, we're seeing engulfing red form off of our liquidity block. The buyers are unable to claim, and they're holding the high volume spike that occurred right here at 11:30 Eastern time, or 10:30 Eastern time. I'm sorry. And now, of course, they're sweeping lower. Once I see those two things, then I'm looking for a lower low. The lower low is the final nail in the coffin for the buyers here. If the sellers can put in a lower low and break the trend, it tells you that the order book is now effectively ready to start looking for lower prices. Because remember, the market is going to seek out liquidity like Pac-Man, like the game Pac-Man back in the day. I don't know if some of y'all kids remember that game from back in the day. So them putting on lower low tells me there's no more liquidity at 68.44. There's too much selling for the buyers to maintain an upward trajectory, and now the buyers have to go lower to start seeking out a lower inventory, to regather inventory and reinitiate their campaign for a higher attack. Right now, here's another low at 68.44. If they can close that price action and sweep that demand, then we have to look for the next liquidity zone on down, which is not really anywhere until the bounce that initiated at 68.20. So volume and wick is going to tell me who's controlling the book on the aggression side of things and whether or not it's just defense. If this price action comes up into this liquidity zone of 68.53 and doesn't put on a major aggressive selling candle like that, then they're just going to defend, the buyers are going to absorb, and they're going to climb higher. And then we'll break that. We'll look for an absorption pattern to break over 68.53 and climb higher, but we didn't. They didn't stay up here. They engulfed this red move down, and we're already, 15 points lower. And if they hold under this lower low, this orange line here, I have it 68.44, then I'll first target, roughly 50% of the range, and then if they break that, then pretty dang good probability that we're going to low of the day. I like your take on the volume spike. Yeah, 100%. So volume, I'm a VPA trader, volume price analysis, and this is my number one. The number one thing I look for in all trades and all bias and all predictions, quote unquote, is volume spike. I let the market tell me what it wants to do and when it wants to do it. I've been reading about GEX, gamma exposure, gamma walls. Do these tend to act as magnets for price action as they more like support? It depends on what environment we're in. That's a great question. I used to use a lot of GEX. I personally don't anymore because I was unable to gain a consistent edge form. Here we go. We're broken to 68.44. My first target on this move is going to be roughly 50% of the range. And I say roughly because that's not a structural move. That's more of a pattern move. 68.36. If we take out the 68.36, then pretty dang good chance that we're going to sweep the low of the day of 68.20. But that's a beautiful red move. That's it's approaching 20 points here. 25,500 is liquidity on NASDAQ. And ES wants 68.35. It depends on what environment. Are we in a negative gamma environment or are we in a positive gamma environment? So it's really depend on the underlying stability of the market, and that is through the positioning of the option chain. If we're in a deeply negative gamma environment, the market is going to be inherently unstable, and we're going to have a lot of erratic movement, simply because the market, the underlying ability for the market makers or the dealers to hedge is going to be determined on their positioning with their deltas. And if we're in a deeply negative gamma environment, there's going to be a lot of selling into selling instead of buying into selling. Positive gamma, you're going to have buy the dip, you're going to have squanchy price action, a lot of back and forth. If you're looking at negative gamma, there's going to be a lot of selling into selling, which means more selling is going to induce more selling as the dealers catch up until their portfolios flip into delta neutral, and they can now flip back over into underlying positioning of the buying. But I personally don't look at GEX levels anymore because there wasn't a lot of clear edge in my system with that. So you see them defending this price here, 68.44, and that's not crystal ball stuff. That's simply because I'm watching the price action tell me what to do. We have these lower wicks right here, so we know that the market's defending 68.44. That's why I need a close under this candle to get me lower. We haven't closed. We dipped below it, but we haven't closed yet, and that's the theme. The reason why I need a close because a closure on whichever time frame you demand. A closure tells me that the price action has fully absorbed the demand that's sitting here. So just like we have this liquidity zone here, this is now my liquidity block to the downside. Let's label it green. This is now my liquidity block to the downside that the sellers must clear to get us down into low of the day. So if you're looking to short, if you're looking to take a put, you need this liquidity to breach this zone here. So we're not in the game of predicting. We're not in the game of looking at our crystal ball because we don't know how to do that. So we're just looking for what the market is trying to do. We have liquidity base here. We have liquidity supply here. The market is stuck. The market is stuck. This has been really insightful. Are you trading volume? Do you keep your eyes on VWAP at all? Is this small bounce? I don't look at any kind of moving averages. So no VWAP, no EMAs. I don't use any of that. Simply because I've always been of the opinion. I try to think very pragmatically. And my thought process is, if that stuff brought value to your charts, then everybody would be successful. Everybody would be millionaires. But they don't. There's no way to gain an edge off of a readily available indicator that you can add to everybody. You know, the market can be very rewarding. Trading is incredibly rewarding when you're successful, but only to those who put in the work. And I don't think there's a lot to be had of value to something that's readily available that anybody can just add to their chart for free. That's my pragmatic approach to those. Now, can it provide some sort of pattern analysis or pattern recognition? 100%, because part of trading is pattern recognition. And if you have an underlying system to identify moves, such as my VPA or whatever you want to use, there can be some value added with those kind of EMAs and moving averages for pattern recognition. But obviously, I think everybody knows there's no structural basis to moving averages or VWAP or anything, because they're just a calculation. But they do help identifying patterns when a pattern arrives. Are the CVD and icebergs positive? Correct, they are. But let's look at this. Look at the book map here. We had a spike on the CVD till about on ES here to 1105 to about 3,000. But what's been happening since? They've been selling off the CVD ever since. So that's why there's two components of the CVD to look at. You've got the underlying subchart indicator graph, and you've got the numerical value here on the bottom right. Some could make the mistake of only looking at the numerical value and assuming that this is very bullish. We have a very bullish CVD or a very green CVD here, so that we can guess that things are bullish, and they may or may not be. However, you have to do a little more digging deep and looking at the subchart. If they're selling off the CVD and continuing to downtrend this, it could be green, but it could be trending towards neutral and then breaking into negative categories. Or it could be spiking green from the morning and just maintaining a green CVD. It's not increasing green or it's not decreasing. It's just maintaining. So you want to look at both components here. Both components to tell you what's actually happening. Like right now, the CVD is building back up. The CVD is increasing. So it's looking like more. We're going to have a 4-3 attack of this upper liquidity block. Right here. You're welcome, Lex. It seems like you're using TradingView. What edge do you get from Bookmap? Bookmap for me here, I've been back and forth with the stream. So Bookmap tells me the skew of the order flow. It's the future order flow. So the TradingView is historical, right? There's nothing future about TradingView. TradingView only tells you the price action that's already occurred. Bookmap tells you the future order flow that hasn't been transacted yet through the process of the order book. And that's the way I do, liquidity discovery. Where is the liquidity at? And the keyword that I always use with Bookmap is skew. That's why I don't zoom all the way in like a lot of other traders who use Bookmap like this. I'm not interested in the ticks. I want to zoom all the way out. I mean, not this far or nothing like that, but I want to zoom in like this to give me a good representation of the current session and where they're skewing the book. So when the market skews lower, I'll look to play lower. If it skews higher, and what do I mean by skew? Where is the preponderance of liquidity? If there's a ton of liquidity, let's say they put on multiple layers of orders, cumulative about 1,500, 2,000, 3,000 orders, all the way down to 6,800 here, then I could make an argument that they could roll this thing over into the afternoon. So it really depends. Now today, there's not a lot to go off of, which sometimes that happens. The order book is pretty well balanced. It's very light. There's no major outlier layers. If I had to take a guess right now, it's skewed higher. We have 6,900, 6,880, 6,860, and not really anything below. So I would say right now, the order book is lightly skewed higher at this point. Same thoughts on Gex levels themselves. I couldn't gain an edge with it. Yeah, I love using the Greeks. Yeah, I love watching options data. Options flow, especially with the zeros, are a great tool to determine what the market wants to shift. But thoughts on bookmaps, such as indicators. I love the Bookmaps iceberg indicator. It's my favorite indicator on the charts. it tells me a lot of underlying intention that may or not be present or obvious. So here's a fourth attack on this upward liquidity at 68.53 right here. So we have a high volume spike as we entered into this mode. You see this 11:10 candle. We had a high volume spike as this liquidity base below the 68.44 and defended. We got no close below, and now we have a green engulfing back up to test the upper range for the fourth time. How can you tell if the price closing below the liquidity block is not a sell trap? It's a good question. Sometimes you are going to get trapped. It's just that's part of the game. It really depends on the current environment. It depends on the setup into it. I personally don't want to go chasing it like a one tap and go. So the market very rarely is V-shaped. It very rarely goes up and then one candle top wicks and sells off. Sometimes it may do that, but very rarely. Most of the time, it does something like this, like what you're seeing on the chart, where it's just back and forth. There's a lot of grinding, there's a lot of absorption, there's a lot of consolidation, and then finally we break lower. So my rule of thumb is I don't want to go chasing the first breakdown or breakout, because most of the time you're going to get wrecked. You're going to get swept. You're going to get reversed instantly. So I want to let the price action build into a climax of events, either a selling climax or a buying climax, to tell me what's actually occurring. Now, the volume helps me, of course, but volume, nothing is guaranteed in trading. I think we all can agree to that. But like right now, if I would have chased that first short position without closing, I would have got wrecked to the tune of about 12, 13 points there. So I really need them to close liquidity or give me some sort of indication that they're ready to break this thing down. And I may get that from the options data. I may see a tremendous amount of liquidity put on the book. I may see a crazy move, because typically how they do a shift from an upside trend to a downside trend is what I call a selling climax. You have a very quick aggressive thrust higher, an immediate top wick, and then you sell back off. And opposite if you're looking for a buy. That's why I don't chase the first quick move breakout of consolidation, because that is usually a liquidity sweep. So from here, if you saw a very quick, very engulfing green candle to like 68.60, and then they immediately top wick it, there's a good chance that that's the move to go down. So, all the way down. Here we go, 68.45, rolling back over. That was the fourth attempt at that liquidity zone, and that's an engulfing candle. So again, nothing's actionable. They're just painting the picture like Bob Ross here. They're just painting the picture. But we have the S&P 5 minute into 68.51. That is 1, 2, 3, 4 attempts at a breakout at 68.50, of which they could not do. We're still not doing nothing. We're not Miss Cleo over here. If they finally clear 68.53, there's a dang good chance that we're going to go to 64 and you'll be rewarded for your patience. But if they don't, the risk reward here is going to go all the way down to the imbalanced low from that data to ADP from 68.17. Right here, baby. You should start a YouTube channel. Thanks, Ian. Appreciate you, buddy. Luckily, I've got a YouTube channel. There you go. Thanks, Dan. Dan's got it for me. Another engulfing red. What time frame is trading view? The one we have right now is the 5 minute. This is a 5 minute chart. I look for volume on the 1 minute. I only do volume analysis on the 1 minute because it gives me the earliest instance of volume analysis, volume inflow. So if you go to the 1 minute, like right here, this is the 1 minute chart. A lot of people scoff at the 1 minute, myself included. I don't do any price action analysis on the 1 minute. However, I do volume analysis on the 1 minute because my goal as a VPA trader is to determine the earliest instance of outlier volume. And obviously we can all see that right here at 10:30 Eastern time, we had the highest amount of volume of the day by double. It was a double amount of volume, and it occurred in this red liquidity block. So that tells you That is why we're rejecting 1, 2, 3, 4 times, because that is where the volume tells me there's supply. Like I said, I break everything down to the most realistic, pragmatic way possible. I take out as much guesswork as I can. I try to take out as much ego as I can, counter to what Mr. DG said at the beginning of the stream. And I'm looking for what the market wants to do here. And then once I figure out the volume on the 1 minute, I switch to the 5 and the 15, depending on how I want to trade. And I determine the second and third criteria of my system, which is wick and then follow through price action. $68.50 liquidity here, $68.35 to the downside. We have NASDAQ liquidity to $25.537. And if they close under the 68.44 on the S&P and get a close under there, we could play down. Until then, you have to remain either neutral or even cautiously bullish until that breaks. If no rate cut, will the market go lower than the last month? I don't know. 888 dogs. And here's my response to news events like this is that I cannot, with the level of either insider trading and or fraud and or whatever is occurring in the background is none of my business. By the way, liquidity just came on 25.5. It's none of my business. It's not my job to know that stuff. The question I ask myself as we get closer to that event of FOMC on December 18th is, or December 13th, what is the market priced in up until that point? If the market is pricing in a cut until the event, and they do not do a cut, there will be a tremendous amount of volatility. Tremendous volatility of like something that we've seen in the end of March, early April of this year. Something like that. I don't know if it's going to be bearish. I don't know if it would be bullish or bearish or not. It doesn't matter. I think we can all know the past 5 years we've seen tremendously bearish news posting result in an incredibly bullish move because it's about the positioning of the market. If everyone is positioned short, if everyone is positioned in puts, then the market's going up because you're going to squeeze those positions to gain liquidity because that is the easiest way to move the market. A crowded market is easiest moved in the counter direction. If the market is skewed puts, if the IV is very high, then blast that thing higher to kill the VIX, kill the put positions, and then when the market is now cleared, you can move it back down as an imbalance. So right now the market is positioned for a cut. If they don't cut or do anything other than a cut, it's going to be tremendously volatile. And that's the only way I approach those things. I don't care if it's bullish or bearish. I don't try to get into all that because it's futile. It's all about volatility. All right, another top wick here. So we're just going to wait patiently. 68.44 will lead lower. Plus, now we have the book map on our side. The book map. 25,500 down, where they're starting to bring liquidity down. The S&P, they've got a little bit of 68.35. Now, it's not incredibly robust. It's not like we're talking about 1,500 lots, but it's a little bit. I know it hasn't been the greatest of price action here during the stream, but I hope making the best of it. Just going through my thoughts here on what we're looking for. Oh, nice, J-Money. I appreciate you. This is the way that I keep myself from trying to jump in front of a bullish train because it's very common, it's very understandable for want to short the highs. The time to short is at the highs. But it's our job to determine when that high is actually going to be, and the volume helps me do that. And what helps me stay neutral until the short signal comes is the lower low, the third criteria of my system. If I don't get that third C, then I'm not going to take a short position. I'm either going to do nothing or I'm going to be cautiously bullish until that breaks and wait for the 68.64. And then if I get my close, then we'll consider a downside position until the low of the day. Yeah, so we also have liquidity. Yeah, we have liquidity based up to 6,900. 157 orders. We have 68 right here, 68.80, and then down into 68.55. Oh, thanks, John. Appreciate you, buddy. Yeah, heat map's fantastic, man. Very visual. It's the reason why I love the book map, because it's visual. It takes all the guesswork out of it. It takes all the the brain bites, and just boom, I can look at it, I can see the liquidity, and I can make my decision. So it's a fantastic tool. Fantastic tool. Yeah, I do think we will get a rate cut. I do think we'll get a rate cut. Yeah, I don't think I think that's guaranteed. All right, so all right, that is the end of the stream. Unfortunately, that's 11:30, so that is the end of our hour together. Price action hasn't moved. I still encourage you to wait for these liquidity levels to tell you what to do, and we'll go from there. If we do break higher, it has been the pattern that in the afternoon, into the last hour of the day, we roll back over. That's what's been happening. So just keep an eye on things here. We have 68, 64 resistance. The market's not going anywhere, but there you go. Can we automatic load cloud notes, or do you have a URL? I think Dan can get that for us. Yeah. Thanks, Ian. I appreciate you, buddy. So other than that, I appreciate you taking time to hang out with us here at Bookmap. Fantastic service. I'd highly encourage you to get Bookmap to help your utilization of the order book. So until next time, we have next Wednesday will be the next Bookmap stream together at 10:30 Eastern Time. So hope you have a good rest of the day. I'm out.